as well as them going wrong, they actually can go really well. So if you find a good joint venture and you can prove to them that your concept has worked, you can prove to them that you can deliver a project, you can prove to them that you can pay them back their initial capital plus the interest element that you agreed. Hi guys, it's Arsh, and in today's video we're going to be talking about joint ventures, and I'm going to be asking the question, do you joint venture or do you not joint venture, and do they actually work? Before we get into that, I just want to mention a couple of things. So as you know, this channel is sponsored by the Property Investor app, which is the UK's first property investment platform. Go and check us out. So there are two ways to get involved. You can either go to the website, which is propertyinvestorapp.co.uk, or if you've got a smartphone, go to the App Store, type in Property Investor and download it from there. Now, as well as that, I'm releasing a new feature on my website. So as some of you may know, I release a podcast every Tuesday at 6 a.m. It's called The Property Rebel. Now I need your help because we're coming up to 3 years of consistently releasing a new episode every Tuesday. But I want you to ask me some questions. I want you to go to my website, which is arshilahi.com/ask Arsh. So I'm going to try and put the link somewhere down there. It will definitely be in the description. And I want you to go to the website and you can do one or two things. You can either leave me a voice note. So a voice note saying, hi Arsh, this is my question. How would you do this? So whatever it may be, if you've got a burning desire of a question, go to arshilahi.com/ask Arsh and leave a voice note. If you're a little bit camera shy, if you're a little bit shy about leaving a voice note, you can actually go there and type in your question and it'll send it to me. And I'm going to be answering some of these questions over on my YouTube channel and also on my podcast. So it's going to give you a great opportunity to ask a question that you probably don't know the answer to right now. So let's get straight into it. In this session, we're going to be talking about joint ventures. So one of the questions that I get asked pretty much every week is, Arsh, do you do joint ventures? Or if I've got funds to invest, will you joint venture with me? Now, joint ventures, for those that don't know, it is what the name suggests. It's a joint venture, which is a definition of two parties coming together for one common goal. So how would a joint venture normally be structured? The way that I see it is that two people got to be coming together and they've got to, let's just talk at it from a property context. So you may have the investor. The investor is the person that may have the cash. They may have the cash, but they don't have the time, they don't have the knowledge, they don't have the skill set, they don't have the management skills, whatever it may be, but they've got the fundamental part, which is the money to be able to invest. Then you've got the person, let's call them the borrower right now. The borrower is the person that has got the skill, has possibly gone out and found the deal, possibly appraised the whole opportunity, but doesn't necessarily have the money to put it together. So as a combination of both of them coming together, you've now got the opportunity to actually create something, actually make something work. Now, in principle, it sounds great. I've got the cash, I've got the skills, let's put it together. The reality is that sometimes it goes well, sometimes it doesn't go so well. Have you ever heard of the phrase, share the risk, share the reward? So some things go well, some things don't go so well. And there's lots of things that sometimes don't go well. So you could talk about delay in timescales. You could talk about the market turning. So some projects haven't made the kind of money that they were hoping to make. And as a result, you've got to kind of have a plan B. So if you are doing joint ventures, think of it, your plan A. What's your plan A? You're going to sell the property. Plan B is that if you don't sell the property, can you refinance the property, or can you be able to get out of it in another way? Because let's face it, the person that is putting in the money, the reality is that they actually want that money back at some point. So these are where the terms are initially defined and then put it into what is considered a joint venture agreement. So there's got to be an agreement. So I can't just come up to you and say, I've got 10 grand, here you go, here's 10 grand. Because again, there's lots of questions to be asked. How is that money secured? Where is that money going? How long are you going to have it for? How am I going to get my money back? So these are the questions that me as an investor would be asking you if I was to lend my money to you. If I give you my money, what are you going to be doing with it? Are you going to be buying a property? Okay, when you buy the property, what are you going to be doing with that property? Are you going to be single let? You're going to turn it into buy to let? Is it going to be service accommodation? Is it going to be a flip? What is it? So in essence, what you could do is you got to create almost like a mini deck or a mini pack to give to me so that I can look at it and think, okay, I understand it. He's going to buy it for 100,000. He's going to spend 20,000. He's going to increase the value to 150,000. He's going to sell it. He's going to make a capital gain. He's going to give my money back. He's going to keep the profit. And as a result, there's going to be a level of interest that I charge for me lending my money to him. And it varies as simple as that. Now, lots of scenarios where, like I said, things can go wrong. Material prices have gone up, time scales delayed, issues with builders run off with, money, materials, whatever it may be. The property may not have valued as high as you initially envisaged. So lots of things can go wrong. So what is plan B? How does the investor get their money? Do they then turn from a short-term investor to a long-term investor? Again, lots of questions that need to be asked, but these all need to be put in the agreement, because if you don't put it in the agreement, it can go quite wrong. Now, I feel like I'm talking quite negatively about joint ventures and partnerships, because as well as them going wrong, they actually can go really well. So if you find a good joint venture and you can prove to them that your concept has worked, you can prove to them that you can deliver a project, you can prove to them that you can pay them back their initial capital plus the interest element that you agreed, there's no reason why that won't become a recurring facility for you and your property journey. So again, you may no longer need the banks or bridging companies to actually fund these transactions, because you've got this investor. And I spoke to a investor and he came to me and goes, Arsh, you know lots of investors, would you put me in contact with your investors? And I kind of said, I'm not 100% sure about that, because I don't know you, I don't know what your background is, but I am actually going to start reaching out to people. So I'm going to say to people, if you guys have got funds to invest, I know people that need funds for projects and I'm happy to kind of run my eye over them. Or B is that I've got projects that, again, I've never really done a joint venture because I've never really felt the need, but I kind of got this thing in my head that perhaps I could do more as a result of having more funds. Now, as you can appreciate, no one's a bottomless pit of cash. That's why there's always a need for investors that have got cash. So again, if you're an investor and you have got cash and it's just sat in the bank, it's actually depreciating sitting in the bank, go out and find project. I'm not saying that you need to lend it to me. You may find another investor. The one thing I will say is that make sure that you've got a good level of security. If you're the person borrowing the money, what I suggest is that you make sure that you provide the investor with the comfort knowing that their funds are safe and it's secured against the asset, it's secured against a guarantee, and they've got a clear vision of how those funds are going to be repaid. When it works really well. When it goes bad, it goes really bad. And I've seen scenarios where people have not been paid back. I've seen scenarios where people have had to go to court. But on the positive side, I've seen lots of scenarios where people have lent people money and they've got it back and they've made their interest, and it's been a lot more than what they've actually generated in the bank. So hopefully that's just kind of give you a smaller inclination as to how joint ventures work. There has to be two willing parties. You've got to clearly identify who's doing what. Is he bringing the cash, or are they bringing the cash? Are they doing the work in returns of the cash that's being borrowed? Is it an equity stake? Is it an interest? Is it just an interest loan? So for argument's sake, you could say that I'm going to lend you £100,000, but I want 1% per month, which is equivalent to 12%, which is equivalent to 12,000. But again, these all need to be defined, and don't just write it on the back of a fag packet. Whatever you do, consult a legal body or a legal person that can draw up a legal binding contract. Now, if you're the investor, you should definitely be making sure that your funds are secured and also backed by a joint venture partnership agreement or some kind of agreement confirming what the funds are for, how long it's going to be there for, and how you're going to be getting it back. Because again, remember what I say, share the reward, share the risk. So some things go up, some things go down, but again, that document defines how all that works. So hopefully you've enjoyed that session, a little bit more practical. Really hope that you've kind of enjoyed that. As I said at the start of this video, that this channel is sponsored by the Property Investor app, which is the UK's first property investment platform, which showcases all kinds of deals all over the UK. Whether you're looking for below market value deals, rent to rent, lease options, service accommodation deals, we've got them all. Now, there are two ways to get involved. You can either go to a website, which is propertyinvestorapp.co.uk, or if you've got a smartphone, go to the App Store, type in Property Investor, download it from there. Now, if you're a property investor and you've got funds to invest and you want to perhaps have a chat with someone to see how's the best way to use those funds, feel free to reach out. Now, you can either go to the website, which is arshilahi.com/contact, or if you want to actually leave me a mini voice note, again, go to arshilahi.com/ask Arsh. As well as that, if you want to listen to my podcast, which we release every Tuesday at 6 a.m, go and check it out. You can go to Apple Podcasts, Google Podcasts, Spotify, Stitcher, just to name a few. It's called The Property Rebel, and we release a new one every Tuesday at 6 a.m. Now, if you want to connect with me on social media, feel free to do so. I'm on Facebook, LinkedIn, Instagram, Twitter, Clubhouse, TikTok, and loads of others, all under the handle of Arshilahi. So I really hope you've enjoyed that session. As always, if you've got any questions, feel free to ask. If you've got any comments, please feel free to leave them below. Don't forget to hit the subscribe and like button, and I look forward to speaking to you all very soon. Thank you. Bye-bye.